Welcome to Lecture 3, Dealing with Datasets. Lecture 2 established the conceptual foundations, research questions, types of study, statistical significance, inference and uncertainty. This lecture turns those foundations into practice. We move from thinking about data to actually working with it, understanding where it comes from, what its limitations are, and the technical steps required to use it responsibly in microsimulation analysis. This lecture opens with a set of very recent policy headlines from 2025. Reeves contemplating a penny on income tax, the two-child limit under review, the Green Party wealth tax proposal, reforms income tax cuts, and asks, how do we analyse what is actually going on with these things? The answer requires the kind of systematic, data-driven framework this lecture develops. The distinctive feature of this lecture is the section on synthetic data. As AI-generated datasets become more widely used in policy research and teaching, understanding what they are, how they are generated, and where they fall short becomes an essential skill. If you have access to an account, please have Practical Demonstration 1 open alongside these slides. The activities build directly on the concepts introduced here. We cover 10 topics, building from motivation through data concepts to practical limitations. The structure mirrors the journey a policy analyst takes. Understand what you are trying to answer, find appropriate data, understand how the data was constructed and what its weaknesses are, and then use it with appropriate humility about what it can and cannot tell you. 3 sections are worth flagging as particularly important for the modelling work in later sessions. The section on grossing up and non-response bias is foundational. It explains how sample data becomes population-level analysis and what can go wrong. Synthetic data reflects a genuinely important development in how policy data can be made accessible without compromising privacy. And the section on other problems, underreporting and question mismatch, is the honest counterpart to the technical machinery. A reminder that the numbers we work with are never perfect representations of the world. This lecture opens with a set of headlines that neatly illustrate why microsimulation matters. In 2025, the UK debate on fiscal policy is pulling in at least 4 different directions simultaneously. A Chancellor who may need to raise income tax to fund public services. The same Chancellor reviewing whether to end a policy that limits benefit payments to the first 2 children in a family. The Green Party proposing a substantial wealth tax on the very wealthy. And Reform proposing sweeping cuts to income tax. These 4 proposals, raise income tax, extend child benefit support, tax wealth, cut income tax, have radically different distributional profiles. Some will benefit the poorest households most. Some will benefit the highest earners. Some will be broadly progressive, others regressive. And critically, some of them interact with each other. If you extend the 2-child limit for benefit payments while also raising income tax, the net effect on a low-income working family depends on the interaction of both changes, not just either in isolation. This is precisely the problem that microsimulation is designed to solve. By applying the rules of the tax and benefit system to a representative sample of real households, it can calculate the distributional effect of each proposal individually, and in combination, revealing who gains and who loses, and by how much, across the full income distribution. Without that analytical capacity, policy debate defaults to assertion and anecdote. With it, the claims made by politicians of all parties can be tested against actual household data. The embedded YouTube video explores the broader applications of microsimulation methods to policy. We group questions that microsimulation is designed to answer into 2 categories. This grouping is worth considering because it structures how you think about every policy change you will analyse. The first question is distributional. Policy changes inevitably produce gainers and losers. Some households will be better off, some worse off, and the pattern of those gains and losses across the income distribution is what determines whether a reform is progressive or regressive. Measuring this requires the poverty and inequality concepts introduced in Lecture 4 and the microsimulation infrastructure built in Lecture 5. The second question is behavioural. Policy changes can alter how people act. An income tax cut changes the effective wage for each additional hour of work. A plastic bag tax changes the relative price of bags versus alternatives. A benefit reform changes the financial return to moving from unemployment into low-paid work. Some of these behavioural responses are intended and beneficial, others are unintended and harmful. The concept of fiscal neutrality organises this thinking. The default presumption is that the fiscal system should not distort economic behaviour unless there is a clear reason to do so. This is why the course focuses on the distributional analysis, the first question, while being alert to the incentive effects, the second. The note on language is worth taking seriously. Approaching poverty, disability, and family structure in a detached, technocratic way can seem distasteful. People's lives are not data points. But the alternative, making policy decisions about poverty without rigorous evidence about who is poor, how poor they are, and what policy changes would improve their position, is worse. The technocratic framework is a tool for producing better outcomes for real people, not an end in itself. The income distribution chart is probably the most important single diagram in UK poverty and inequality analysis, and the 2023/24 version gives us the most current picture available. Let us work through what it shows. The x-axis shows equivalised net household income in £10 bands per week. Equivalised means household income has been adjusted for household size and composition. We will come to exactly what that means in Lecture 4. Net means after income tax and national insurance. Before housing costs means housing costs have not yet been deducted. There is also an after housing costs version, and both appear in official statistics. The mean of £792 is nearly £150 higher than the median of £650. This gap reflects the right-skewed nature of income distributions. Most people have incomes in the £300 to £700 range, but a small number of very high earners pull the mean upward. The median is unaffected by extreme values at the top, moving the richest person's income from £2,000 to £20,000 per week has no effect on the median whatsoever. This is why most serious poverty and inequality analysis uses the median as the reference point rather than the mean. The poverty line at 60% of median income sits just below the start of the third decile. You can read this directly from the chart. The shaded area to the left of the poverty line represents approximately the lowest two deciles, suggesting roughly 18 to 20% of the population falls below the relative poverty threshold. When you hear official child poverty statistics, currently around 30% of children, note that the child poverty rate is higher than the overall population poverty rate because children are disproportionately concentrated in lower-income households. The embedded YouTube video explains measures of inequality further. The preference for the median over the mean in distributional analysis is not merely statistical convention. It has a substantive justification. The problem with the mean for poverty and inequality analysis is its sensitivity to extreme values. If 100 households have incomes between £200 and £800 per week, and one household has an income of £50,000 per week, the mean is distorted substantially upward by that one extreme observation. The median is completely unaffected. It is just the middle value, regardless of what happens at the extremes. The measurement problem with high incomes compounds this. Very wealthy households are less likely to participate in the FRS. They have more resources to decline, and more reason to be cautious about providing financial information. Those who do participate tend to understate their income, partly because their income sources, capital gains, complex business structures, offshore assets, do not map neatly onto the FRS questionnaire. The practical solution the HBAI uses is to replace reported incomes from the very richest respondents with values imputed from income tax records, which are more reliable but still imperfect. This is why, what does this policy do for the average person, is often a politically loaded rather than technically precise question. If average means mean, the average person is in the upper half of the 7th decile, richer than roughly 65% of the population. If average means median, they are at the midpoint of the distribution. The decile framework avoids this ambiguity by showing the distributional profile across all 10 income groups simultaneously, which is both more informative and more honest about how the same policy can be good news for some and bad news for others. The datasets described in this section are the empirical foundation of everything in lectures 4 through 9. Understanding what each is designed to do and where it falls short is essential for interpreting and critiquing microsimulation evidence. The FRS is the workhorse. At around 17,750 households in the 2023/24 data, it is large enough for most national distributional analysis, detailed enough in its income questions to model income tax and most means-tested benefits, and quality-assured BioNS. It is the dataset on which the Landman tax transfer model runs for direct tax and benefit analysis. The LCF has a different speciality: expenditure. It is the only major UK household survey that records what households actually spend via diary methods where participants record every purchase over a 2-week period. This expenditure data is what makes indirect tax analysis, VAT, excise duties, possible. It is also the source of the spending share data used to compile the Consumer Prices Index, CPI, and Retail Prices Index, RPI, inflation measures. CPI measures consumer price inflation and is the basis for the Bank of England's inflation target. RPI is a wider measure including housing costs that was historically used to uprate benefits before being replaced by the CPI in 2011. Its limitation is sample size, around 5,000 households per year, which means granular subgroup analysis requires pooling across multiple years. Understanding society's distinctive feature is its longitudinal panel structure. By following the same households year after year across 12 waves from 2009 to 2022, it enables the within-between modelling that underpins the health microsimulation in Lecture 7. You cannot do that analysis with cross-sectional data, however large. The trade-off is that longitudinal surveys are more expensive to run, more sensitive to attrition, and tend to ask fewer burdensome questions about financial details than cross-sectional surveys can ask of a new sample each year. The synthetic data section reflects a genuine and important development in how policy data can be made more accessible without compromising privacy. Let me explain why this matters and what its current limitations are. The problem is straightforward. The Family Resources Survey contains detailed information about real households, their incomes, benefit entitlements, family composition, disability status, employment. Publishing this data openly would risk identifying individuals, even when names and addresses are removed, because the combination of characteristics can be identifying. The UK Data Archive releases FRS data under a strict end-user license that requires secure storage and prohibits redistribution. For teaching purposes, this creates a barrier. Students cannot freely download and work with the real data. Synthetic data addresses this by generating a dataset that has the same statistical structure as the real data, the same distribution of incomes, the same proportion of lone parent households, the same rates of disability, without any individual record corresponding to a real person. The algorithms learn the joint distribution of all variables in the real dataset, and then sample from that learned distribution to produce a new dataset of the same size. The synthetic data is not just random noise, it is structurally similar to the real thing. The limitations are real. Current synthetic data algorithms are good at matching univariate distributions. Each variable individually looks realistic. They are less good at preserving the complex multivariate relationships that microsimulation depends on. Whether a person is in universal credit depends on their income, family structure, housing tenure, employment status, and disability in combination. Getting all of those relationships right simultaneously is harder than getting anyone right alone. Synthetic data is necessarily a bit simpler than actual datasets and possibly a bit wonky round the edges. For learning the concepts, it works well. For published policy research, real FRS data accessed through the UK Data Archive is required. The embedded YouTube video explores some of these issues in greater detail. Grossing up is a simple idea with important technical complexity underneath. The basic logic: if the survey sampled one household in every 2,000 in the UK, and we observed 200 disabled households in the survey, our best estimate of the total disabled household population is 400,000. We multiply each observation by the grossing factor of 2,000 to produce population-level estimates. The complication is non-response. Unlike the census, which is legally mandatory, the FRS and LCF are voluntary surveys. Participation has declined from over 80% in the early 1960s to around 50% today. If the 50% who refuse to participate were identical to the 50% who agree, this would not matter. We would just have a smaller sample. But they are not identical. High-income households are harder to recruit, partly because they have more resources to decline and less time to spare, and partly because their financial affairs are more complex and they may be more cautious about sharing financial information. Households with sick or disabled members may find interview participation burdensome. The result is a sample that systematically underrepresents certain groups. Differential weighting is the practical solution. If we know from the census that pensioners make up 28% of all UK households, but only 20% of our survey sample, we can upweight pensioner observations so that their contribution to population estimates matches their actual share of the population. In practice, the weighting must adjust simultaneously for age, income, household type, region, and other characteristics. A constrained optimization problem that requires statistical algorithms developed by researchers, including Creedy. The weights in the FRS and the models built on it are the output of this process, and they are essential for producing nationally representative results. Uncertainty, quantification in microsimulation is harder than in simple survey analysis, and this lecture introduces bootstrapping as the practical solution. Let me explain why the standard approaches do not work here and what bootstrapping does instead. For a simple question, what proportion of UK households have a disabled member? There are standard formulas for confidence intervals that follow from the binomial distribution and the sample size. These work because the estimate is a simple function of one binary variable. Microsimulation is different in kind. A household's universal credit entitlement depends on their net income, their housing costs, whether they have children, their hours of work, their health status, whether they are in the legacy system or the UC system, and several other factors. The estimated population level effect of changing the UC taper rate is a function of all of these variables simultaneously. There is no analytical formula for the confidence interval around that estimate. It is too complex. Bootstrapping solves this computationally rather than analytically. The procedure is: take your sample, randomly delete a few observations, and replace them by resampling from the remaining data, rerun the entire microsimulation on this slightly perturbed sample, and record the result. Repeat this hundreds or thousands of times. The distribution of results across these replications gives you an empirical estimate of the uncertainty. If 95% of the Bootstrap replications produce a result between X and Y, then the 95% confidence interval for your estimate is approximately X to Y. This is computationally expensive, but methodologically sound. Lecture 7 uses exactly this approach to estimate confidence intervals for the health impact findings from the basic income microsimulation. The embedded YouTube video explains bootstrapping in greater detail. This lecture closes with a section on practical limitations that is important precisely because the preceding sections could leave the impression that survey data, properly grossed up and weighted, gives a reliable picture of reality. It does, but imperfectly, and in ways that matter for specific analyses. The tobacco and alcohol underreporting finding is striking. The LCF records spending on these items at roughly half the level that His Majesty's Revenue and Customs, HMRC Customs and Excise data suggests they should be at based on revenue from tobacco duties and alcohol duties. HMRC is the UK government department responsible for collecting taxes, administering tax credits and enforcing customs regulations, and publishes aggregate revenue data used to validate microsimulation outputs. This gap is well documented and has multiple explanations. Some respondents probably understate their purchases out of embarrassment. Some purchases by tourists, by businesses, through illicit markets, fall outside the household sample frame and so genuinely do not appear in the data. And diary-based measurement of expenditure introduces recall error. The policy implication of this underreporting is subtle and somewhat counterintuitive. If you correct for tobacco and alcohol underreporting by grossing up the recorded amounts, multiplying them by a factor of roughly 2 to match customs data, you improve your model's ability to predict aggregate tax revenues from tobacco and alcohol duties. But you may worsen your distributional analysis. If some households are genuinely light drinkers and others are heavy drinkers, but all households' recorded amounts are scaled up equally, you overstate the concentration of tobacco and alcohol spending among households who already recorded more. This is an example of the general principle that improving aggregate accuracy can worsen distributional accuracy. The self-employment income problem is the most practically significant for microsimulation of the UK tax system. The FRS asks self-employed people about their income in ways that capture their broad financial situation, but not the details needed to model income tax accurately. Self-employment income can take many forms: drawings from partnerships, directors' remuneration, personal service company structures, that the survey cannot distinguish. This creates systematic error in the modelled income tax liability of self-employed households. Understanding which parts of the model are more reliable and which less so is essential for interpreting its outputs appropriately. Let me bring together the 5 threads that have run through this lecture, because the connections between them are as important as the individual topics. The first thread is purpose. We started with 4 policy headlines: an income tax penny, the 2-child limit, a wealth tax, income tax cuts, that are in direct tension with each other and that cannot be evaluated without answering 2 questions. Who gains and who loses, and how do incentives change? Everything in this lecture, every data set, every methodological correction, every measure exists to make those 2 answers possible and honest. The second thread is the income distribution itself. The key numbers are worth carrying with you. Mean income, £792 per week. Median, £650 per week. Poverty line, approximately £390 per week. The gap between mean and median is not a technical curiosity. It is the signature of inequality, And it means that a policy described as helping the average person may, in practice, help someone in the upper half of the seventh decile. Every time you hear that phrase, ask which average and whose income is being measured. The third thread is dataset choice. The FRS, the LCF, the WAS, and Understanding Society. Each do something the others cannot. The FRS gives you income and benefit entitlement in detail. The LCF gives you spending. The WAS gives you wealth. Understanding Society gives you the same households year after year, which is what you need to model health trajectories. In Lecture 4, we build a model on the FRS. In Lecture 7, we extend it to health outcomes using Understanding Society. The choice of dataset is not a preliminary administrative decision. It is an analytical commitment that shapes everything that follows. The fourth thread is systematic bias. Response rates have halved since the 1960s, and non-response is not random. It is concentrated at the top and bottom of the income distribution, exactly where policy effects are most important. The LCF records alcohol and tobacco spending at roughly half its true level. The richest FRS respondents' incomes are replaced with imputed values from tax records because the self-reported figures are so unreliable. None of this is a reason to distrust the data entirely. It is a reason to correct for it explicitly, report your corrections, and be honest about what residual uncertainty remains. The fifth thread is the relationship between aggregate accuracy and distributional accuracy. A model that correctly predicts total income tax revenue while systematically misclassifying which households pay it is useful for one purpose and useless for another. Distributional analysis requires accuracy at the household level, not just in the aggregate. Bootstrapping gives us honest confidence intervals for complex multivariable models. Differential weighting corrects for known sampling biases. These are not optional refinements for academic papers. They are the basic professional standards of the field. Lecture 4 puts all of this to work. We will load a synthetic dataset structured like the FRS, write functions that calculate tax liability and benefit entitlement for each household in turn, aggregate the results to produce the fiscal statistics you now know how to interpret, and draw the DCL chart that shows who gains and who loses. Everything you have learned today about the shape of the income distribution, about the data sets, about the limitations and corrections, is the conceptual scaffolding for that model. You will now understand what the numbers mean and why the corrections matter. If you have access to an account, please now examine Practical Demonstration 1.